Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, December 12th, 2025. It's 11:32 a.m. Eastern Time, so I'm starting the video. And here's what I'm going to do in this one. I'll start out with the short-term charts, the intraday charts. We're looking at a 15-minute here. I'll jump out to 60 daily and weekly. I'm going to keep the video focused primarily to the stock market. So we'll look at the major indices. Definitely want to do get into the semis. In fact, I did a video for you yesterday. I told you I'm kind of in and out. Don't I cut back on trading activity this time of the year unless there's an opportunity. And that video ran so long, it went over an hour, and so I was uploading it, taking a while. I walked away from my desk. Never returned back yesterday. I did that, finished in the afternoon. If you're interested, I'll post a link. Let me know. I'll post a link in the comment section below. You can watch that video if you're a glutton for punishment. But again, I realize it went over an hour. And in it, I talk about update on Oracle. I had several comments there. And I wanted to get into the semis, but again, that video just went too long. If it goes after an hour, don't have time to do a deep dive. So in this video, we will start out with the equity markets. I'm going to show you what I think are really just, I think there's three main charts. I mean, I follow a lot of things, but three charts that paint the bigger picture. Okay, and so remember, as I'm doing this, shorter term charts, intraday charts like this 15-minute we're looking at here are very useful for predicting where prices are going or where anything's going in the short term, obviously, right? You're not looking at a multi-month or multi-year trade, a position that you're going to hold that long if you're trading off a 15-minute or 60-minute chart. Now, they get you in earlier, and a lot of times I will use the intraday charts, typically the 60-minute, to get long when I'm bullish something that's setting up on the daily chart, sometimes even the weekly chart, or on the flip side to short it. So, all right, without further ado, I'm going to jump in here. I'm going to cover the indices, the S&P 500, NASDAQ 100, the small caps, and then I'm going to get into the semis. Before I get to the semis, I'm going to kind of give you my bigger view, longer term outlook when I get to the weekly charts here. Let's try to do it that way. So again, starting short term, this is a 15-minute chart. If I neglect to mention, you can usually see up here a 15-minute time frame, both those two things there. And it's kind of just a great swing trading, active trading time frame. That was our last official short trade we had right there, with an entry to come on a break of that bearish rise. Bearish rising wedge, hit my first, second, third, fourth target. I covered this in yesterday's video. I showed the charts, how we gamed this bounce and then reshorted back there after going long on the bounce based on that was on the futures. That's where I gave it to you. I'm drawing divergence lines. It was a bearish rising wedge. I think that was it. So, we took this entire, milked almost every cent of that move down to the final target there for about an 8% drop, but then turned around and were able to reverse as active traders and turn that into about a 16% plus profit. In other words, by just gaming the zigs and zags along the way down, at least the big ones. Now we've come, as I've said recently, and as including that video I'll share with you yesterday, but I've been talking about, we've come full circle, meaning we ended that with a divergent low on that day. That was what was the date there? The 21st, stated, covering all shorts, going full long, and along the way I took profits. I just wanted to game a bounce off there, and then started scaling back into some swing positions short. And I told you, and I'll get to those levels again. I always have to remind myself that there are new folks coming in or existing subscribers that may have been, not actively trading or checking in the site lately. So a lot of what I do is repetitive, and I'll go over the levels and developments I'm watching and waiting for to go into a more aggressive, longer term, or typical swings / trend short position. So we put in this divergent high. Recently made a ever so slightly marginal new divergent high, again on this little 15-minute time frame, right? The NASDAQ 100, those sell signals I gave you back a couple months ago, the end of October, are still intact. Those were the Okay, had to take a phone call there. Where was I? All right, so all right, guys, let me move a little faster. You can see watch, rinse, repeat, right? We get a divergent high. We traded that one. I had two targets given to you at the time. We hit the second one, reverse or covered it there. So we milked that. That was the biggest drop in a while at the time. Then we gamed that one down with near perfection. And now we're, again, we've come full circle and divergent high. We're starting to get some momentum to the downside. You can see the only thing I think I've added since the last update was this trend line there. And now let's step it out because remember, this is short-term stuff. Although you can see typically the scope of the moves are more than just this. That one was pretty small. And again, I only had two targets for you there. As I told you, if we step back out here to the 60, there's the 60-minute chart, my favorite swing trading time frame, if you will. Nice divergence, just like we had a divergent high right there, just like we had a divergent low there that gave us this move. Again, this is swing trading 101 right here. And then if you recall, or I'll reiterate, when we had this, we had sell signals recently on the daily. We had that breakdown of the purple trend line there. We back tested it there, and then we broke the secondary trend line and back tested. We also on the weekly, which I'll get to in 1 second, we put a bearish engulfing candle in there, which so far has marked the top. We'll see if it's taken out. Nothing surprises me. As I mentioned in the video yesterday, if I'll get out to you, if you care to watch it, this, and I've said this recently, you have a seasonality right now, tends to be bullish. The whole Santa rally thing, year-end position squaring, 401k last minute catch up contributions, all that stuff floods the market. So, most of the time you're going to be positive in January. So, as I said, if we do happen to pop up here, this so far is nothing more than just the down day. Any marginal new high anytime soon. Again, let me repeat that. Any marginal, meaning not a 10-20% pop over the highs, marginal, slight, whether it's equal or a 1, 2, 3, 4%, and anytime soon will be 100% what we're guaranteed to be simply an extension of the existing divergences, negative divergences on the daily as well as the weekly charts. Divergences, I often say, and it bears repeating, are not sell signals. Sell signals come on breaks of support, breakdowns below bearish chart patterns. I'm going to get to some of those in a second. Those are your sell signals. Now we're already on sell signals there, and that I gave you two near-term swing targets. These are for typical swing traders with holding periods measured in weeks to months, right? And so we hit the first target. We covered our shorts there. That was also the final target on those 15 and 60-minute charts I gave you recently. Again, the last trade that we milked from the highs to lows. And the reason I list multiple targets is upon the initial tag of each target, when they're first laid out, a reaction's likely. Now, as you guys know, when we're in a trade, I will often share my thoughts when a target's hit, whether or not I expect a reaction or think the reaction will be little, if any, and in which case I'll usually sit and hold tight instead of trying to game the bounce, right? So all this is at this point in time is the typical reaction, meaning, bounce off that first target. And so I see no reason to, change or modify or remove this. T2 is going to take us back to the 200-day moving averages as well. Now, T2 it's a price support level, but more so you also have the 200 exponential and 200 simple. And the price right now, that price support level, which is a rough target, you want to always cover a little bit below, cover a short a little above the actual price levels I give you, because those are the support levels where reaction's likely. And as I often say, quite often traders just like me will step in early to they don't want to risk the turn in case the buyers step in a little bit early. Likewise, on long trades, I will almost always sell a little shy of the resistance level that I'm targeting and expecting a reversal off of. Okay, so there's your, that's kind of the no change really in the last few weeks, and my outlook or the targets. Then you have the weekly charts, and again, as I've showed you, we put in a bearish engulfing candle back here in late October. Still, so far, is marking the top. Like I said, one strategy when you see a bearish engulfing, you can put take the short and set your stop above it. As I've said repeatedly recently, this market, again, it's how it's evolved over the years. You almost have to expect they know where the stops are. They meaning the nefarious forces, trading firms, trading desks, algorithmic trading programs, all that good stuff. Remember, at this advent of free trading, I'm going to get to Robinhood in a second, but with the advent of the zero commissions, that comes at a cost. They're only doing that because they're making their money back manyfold over or more so by selling your data to the exchanges and to the high frequency traders and all that. That's what free trades are all about. My primary broker, I don't use it. I have an option of Interactive Brokers to have free trades or pay for my trades, but then keep that data not being sold. And that, to me, is what I do. I also hide my stops and all that kinds of other stuff. If you have questions on that, I can tell you how to do that. All right, so back here, as I mentioned, we had a bearish engulfing. I noted at the time it was divergent high as well. We had a sell signal as well. And then we went on, we had a little kickback rally, made a ever so slightly marginal and still divergent high and put a second bearish. And so that's an example, as I said, where if you had a very tight stop above your bearish engulfing back here, they would have got it. They would have clipped you out. You would have been pissed off because they, meaning the nefarious forces, would have taken your short, caused you to stop out. They would have turned around, shorted it, reversed their position, and probably milked a good part of that move down. But of course, we had a second sell signal there, and we were on the, using the 60-minute charts. We got in and we milked that thing as well. All right, so that's the big picture on the NASDAQ 100. While we're on the weekly time frame, let me just step down and show you what the 60 looks like on SPY, and then I'll get to the weekly. This is the SPY S&P 500 60-minute chart. You can see we had a divergent high there, followed by a drop, divergent high, followed by a drop. That's where we shorted we were shorting the NASDAQ 100. That's the counter trend bounce we took in the NASDAQ 100, and this is that last leg down where we covered. And just like the NASDAQ 100, we ended that with a divergent low. Again, my go-to swing trading time frame, divergent high. And we had divergence on, I used the 15-minute chart, if you recall, on QQQ, and SPY will show that as well, was a divergent high there. And that's one reason I was using that chart. And then we had the divergent low, and final targets were hit. And that's it. We've come full circle. This is the first divergent high that we've had on the indexes since back here. All right, hard stop. So we'll see if it plays out or not. Divergences are not a sell signal, but what are sell signals or breaks of support? I don't have a great trend line on QQQ or SPY, and I mentioned that in that video. I'll post a link to yesterday. So you don't always have that optimal entry point. But these are momentum indicators. The way they work, it's not magic. It shows that in a downtrend, when you start building positive divergence, the downside momentum is waning, meaning that force of that moves stocks up or down, called supply and demand, is shifting from more sellers, gradually fewer and fewer sellers, more buyers, and that's what these momentum indicators tell you. Momentum is shifting, and so they're indicative and pretty accurate in telling you a trend change is likely coming. And then you look for the other reasons. In that case, we didn't wait for a breakout. We covered because our targets were hit, and for the other reasons, support levels were hit, and we're oversold, and et cetera, et cetera. Now let's go to this. Let's go to the weekly chart. Oh, well, there's the daily if you want to see the S&P 500. We've been in this trading range now. You can see I have these purple boxes, just like back here. I remember clearly. The bobbleheads on TV were all out bullish. Was starting to get some feedback on the site, kind of angry folks that, this market will never go down. And what happened one day, it just stopped going up, but it wasn't going down much. We were in a trading range, and then I boxed these in. And I always say these trading ranges, sometimes they are just a high-level consolidation. An asset will take a pause and then break out. And if that's where you break out, as long as it's not a failed breakout, or I'll often tell you also, I'll tell you which breakouts that I will not take and which ones I'll even sometimes short. And that are breaks when I see strong negative divergences, excessive sentiment, and all that. Just like now, I'll anticipate and welcome a breakout and predict that it will most likely fail. And the key is you can take the breakout, you can short it if you want. And hey, if you're bullish, take it, put a stop below, right? But the best thing to do is wait for the breakout to fail. In this case, what you had, just like the S&P, then effectively a double top, the divergence got even bigger, and then finally there was your sell signal. Very powerful stuff. You had months of energy building like a coiled spring. You broke down, and in one fell swoop, you broke both the trading range and you took out, if you can see here, these blue and red lines, the 200-day moving averages. It was game on then. So if you didn't want to short there, like a lot of folks didn't, you had another opportunity here, even a more objective. The second mouse kind of thing, where, second mouse gets the cheese. And then if you missed that, because it happened pretty quick, you were given a gift, which was highlighted at the time, a back test of the 200-day moving averages. And then from there, so if you took that, and this was before Trump stepped to the podium, you had another 15% downside in the S&P, and probably more than that in QQQ, right? So that's that. And this, again, is very similar to this sideways price action. In both, you have a trading range, and you also have a divergent high here, another run at that high, still a divergent high as of now. The day is early, but you have a bearish engulfing candle on the daily right here, almost on SPY. You might have it on QQQ. And there's your divergence lines. And so the big level will be obviously a break of this. If you've been following me for a while, I've been saying forever and a day since October 10th, the market will not drop until it takes out the October 10th lows. And that, to me, is where I'll increase and can make a case to get more aggressively short for swing and short and trend positions. We successfully tested those October 10th lows right here recently. And that's also when we covered our last short, right? From there to there, went long. So this is still the level, guys. If you want to keep this very simple, I've been talking now for 17 minutes, but I've been saying the same thing for months. This is the key level that I believe will open the door to much more downside, at minimum a run back down to the 200-day moving averages, and based on the longer term outlook, more likely take out the 200s. Let me toggle over to this board. I shared with you something just a week or two ago. I noticed in the Wilshire 5000, VTI, the broad-based, the ETFs and the sectors that track the entire stock market, including SPY. SPY is only 500 stocks, and they're the 500 largest. VTI, as I told you, is probably the single best, well, without a doubt, the single best ETF for tracking the entire stock market, because it has, as I've told you, it attempts to track every single publicly traded stock, small, mid, large, micro caps, all of them. That's what this index is doing, basically the Wilshire 5000. And so just like SPY, it has what I've noticed is called a broadening wedge pattern, aka megaphone pattern. And I've shared a strategy with you in recent videos. We've used it in the past with success here. It's called a partial rise. And that is, once you need to have at least 3 reactions on the wedge pattern on one side and 2 on the other. So that certainly qualifies there. We have plenty of reactions. And then when you see a rise into the wedge, you want to wait for a reversal. That's the safe bet. Again, second mouse gets the cheese. First mouse might try to say, you know what, I'm going to anticipate a partial rise. And sure, you can certainly take it there. Right now, we're starting to reverse. This is a weekly chart. Today is Friday, so you're not going to see anything huge, but it is a reversal, and you can see it a little clearer on the daily chart right there. So I think it's prudent to say, that again, depending, let's say you have 0 positioning right now, and let's just say that you want to be short. Again, seasonality, guys, I would not bet the farm on it at anything, and I wouldn't bet the farm long either. I wouldn't bet it long or short, but it's objective with a stop somewhat above. Somewhat's going to be relative to your price targets. Remember, if this works, they're topping patterns. Last time it gave you a drop in VTI in the market of about 22%. I trade QQQ usually, because if you're going to get the call right on the market, as I say, You're either going to get the call right or wrong. And if you're going to get it right, why not get paid? It's the same logic. You can trade GLD or you can trade GDX, right? You're either going to be right on where gold's going or wrong. You're going to get paid a lot more if you get it right by using GDX. It's the same logic on using QQQ. It's just a more concentrated um, um, view of the market and the big stocks that move the market. So there was QQQ, there was your bearish engulfing, there was that drop, there's your bearish engulfing, so forth and so on. Okay, for those of you folks still with me, now since I jumped out, ended there with the long-term chart, showed you what things look like on the indexes, on the weekly charts. No need right now to go to the monthly. I've covered those before. I'm going to show you 3 charts that are not the stock market that formulate my longer term outlook. Now, again, very important here. These are not timing indicators. We use the 60-minute chart or the daily or even the weekly charts to tell us when to get long, when to get short. But this will tell me where things are going in not just the coming days, coming weeks, but more so the coming years. And this is the federal funds rate chart I've shared with you many times before. One that I'm surprised isn't covered almost daily on bubble TV and all that. But again, it would work against some's narrative, many people's narrative. And it just shows you these shaded lines here. These shaded gray areas are recessions, right? As declared by the NBER. And that was the last one we had. If you blinked, you missed it. It was COVID because the government hit the nuclear button. And right as it was getting going, if you print enough money and send enough checks to everybody, every person and every business, as we did here in the U.S., just about, metaphorically speaking, yeah, you can change your trajectory of the economy. Anywho, we'll see. I think there'll be a price to pay for it. But either way, my point is that, what you see leading up to recession, again, the blue line's the federal funds rate. You have a rate hiking cycle. And then right around the time the recession starts, the Fed starts cutting rates. Remember, the NBER, always declares recessions in hindsight. They're going to come back in. They're going to tell you a recession started after they announce it. Before. They will go in and they backdate those things, right? So just keep that in mind. So you can see, but what will typically happen is rates will plateau right before the recession starts. Then the rate cutting cycle begins, right? Rate hiking cycle, rates plateau, recession starts right around the time the Fed starts cutting rates. Rates go up, Fed starts cutting rates. This was that wonky runaway inflation period back here. So things did get a little wonky, but again, you can see the rate cuts coming. You can see a rate hiking cycle. Fed starts cutting rates, recession follows. Rates stop, that's the rate hiking cycle ends here. They plateau for a little while, just about now, about the same thing. Fed starts cutting rates, a recession follows. Rate hiking cycle plateaus, Fed holds steady for a while, then they start cutting and the recession follows, right? I mean, come on, guys. I've never seen a more predictable pattern that I can recall in the financial markets. So if you had to take a wild flipping guess, what would you say now? That we're going to have that good 2026 like the majority of pundits, even the Fed themselves are predicting? If you listen to the commentary, Powell's press conference, or if you read the articles that followed in the next few days, it's a flipping joke. These guys are insanely stupid because they're predicting weaker employment. They're giving you positive GDP projections. So they don't see a recession. They see positive GDP growth next year, but declining employment. And that's what they're citing as their cause for cutting rates. You cannot have both. I'll show you that chart in a second. I don't think I pulled it up, but I can cue it up. You've seen it before. Anywho, that's one. The other one is this one. And again, guys, long-term stuff. But this is the FINRA margin debt. That is when you open an account at a stockbroker. brokerage house, you can either do a cash account, which says if you have a dollar, you're allowed to buy $1 of stock. Or, as many people do, you can sign a little paper called a rehypothecation agreement, which allows them to loan your stock out to other people like me who like to short. And that's called a margin account. And when you have a margin account, you can buy more stock against the value of securities. So if you have a dollar, your broker will let you buy $4 of stock, right? $1 of your cash, leverage up. So if you buy $4 of stock and it goes up, whatever, let's say you bought NVIDIA at the right time and now you've made, you took your account to $8 from $4. Really, you only put $1 and now you've made it 800% return on your money. That's leverage. That leverage cuts both ways. But what we know for certain, let's not get in the nitty gritty of it. I think most of you understand the concept of leverage and how it, of course, cuts both ways. What is just about an immutable fact or condition is during bull markets, the red line is the S&P 500, and you can see down here, and the blue line is the margin debt. In bull markets, remember, we've had 3 real bull markets as far back as this chart will go. Going back into the 90s, we've had 3 real bull markets. The dot-com bubble, we call that one, the roaring 90s. It popped, the bubble popped in March of 2000. It doesn't look like a lot here, but the NASDAQ, which was the crux of it, and again, my preferred trading index, dropped about 80%. I repeat, if you had $1 million at the end of it, if you didn't pull your money out, you were now left with $200,000. You lost almost everything you had. And that took years, decades, for that to come back to where it was. The S&P fell less, more diversified, but it still was a nice fat bear market. And again, what did you see? You saw a peak in margin interest. So we know, again, this is almost an immutable, it has been an immutable condition that during bull markets, we started our next bull market here. Guys, remember this, the chart's not set to log scaling, so it's going to distort. These don't look like big moves. They were bull and bear markets. That was the financial crisis. Both the NASDAQ and the S&P fell over 55%, right? Doesn't look like a lot because that's what linear scaling will do. It gives you, it tends to make the past returns look a lot smaller. But what we knew is what happened is, again, right at the peak, margin interest, and it didn't just peak. You can kind of see it. It goes parabolic at the end. You get this little like surge. And again, that was what I consider. Now, this will go down in history. COVID was technically a bear market. The S&P fell 36%. This was technically a bear market. We traded that. And you can use those too. You can see margin interest peaked here. COVID was kind of a one-off situation too, with the pandemic and the virus kind of catching the markets off guard, even though the charts had predicted a big drop in a bear market. You can see again now what happened. They flooded the system with liquidity, so margin went crazy. Free money for everybody. You can, near free money. Zero interest rate policy, and they kept the pedal to the metal. And so what happened? That bubble needed to be pricked, but there was so much liquidity floating in the system. It's mind-boggling. It really is. If you study financial markets, just the massive amount of liquidity by not just the U.S., all central banks, and fiscal stimulus as well. Let's not forget the amount of fiscal stimulus we still have today. A lot of government spending and other stuff that was injected into the global financial system then, and that still carries through to today. But what I can tell you for a fact is we're going almost parabolic here, both with the market and in this margin debt. And so the $1 million question, again, this is not a timing indicator. It just says when it reverses, it goes the other way for the reasons I've stated. It is a vicious cycle. Selling begets more selling. When you drop 10%, those folks that put $1 in and now have been bought $400 of stock, or $4 of stock, a 10% drop means they've lost 40 cents on their $4, right? Tracking the math. But 40 cents on the $1 of their own money they have, now they're down 40%. They're going to get a margin call. And then what happens, and I can promise you this, I'm generalizing here, I'm not being exact, but these folks are loaded with Bitcoin, Nvidia, semiconductor stocks, all things AI. That's where a lot of the margin buying is taking place. Bitcoin, obviously, once they legitimized Bitcoin by rolling out these ETFs. So when, it's not if, but when this goes the other way, again, it'll be a vicious cycle. It's a vicious cycle on the way up because that margin, as those people's accounts go up, they're allowed to buy more Nvidia, more Bitcoin, more meme stocks, more GE, whatever they want to buy. And when it goes the other way, falling prices, selling begets more selling. It is, again, a vicious cycle because they get a margin call. And either they sell, if you've had one before, what you do, in the old days, when I was a broker, I could, back in the mid 90s, 7 days, I think the T+7, they could, or even with a margin call, T+7 was 7 a day, then went to T5, T+5, then T+3, and keep moving it forward. But no, it wasn't a big deal. Your customer call them, hey, you have a margin call. You got to mail me a check for $10,000, and just try to get it here by next week. Nowadays, most of the brokers, Robinhood, Interactive Brokers, electronic trading, you get a margin call. Usually you have to the end of the day, and if you don't pick something to sell, they pick it for you. And so, and then what also happens, as I talked about, is when volatility spikes up, once that show starts, just, again, guys, you got to break the levels. All we've had lately are corrections. We get deep enough, we start blasting down through the 200-day moving averages again, flip some long-term indicators, break some key support levels. Then not only does selling beget more selling, but the brokerage houses will tighten up, or even the exchanges will increase margin requirements. And that hurts those that are already on margin, because then they say, look, by the end of tomorrow or end of today, we're going to increase the margin requirements, meaning they've just reduced your buying power, and that further exacerbates the selling there because you get more margin calls. So, guys, we're not there yet, but this is what it looks like. This is what it looks like. If, again, it's not even reflected here, and if you put the NASDAQ 100, you'd see a much bigger drop. It's a extremely beautiful thing to be short during, and it is extremely painful to be long. Guys, I am talking long term here. That's not my long term right now. All right, just something to keep in mind. You don't have to act on it today. We may blast through new highs by year end. I don't know. Short-term charts will be my guide. This is for what will probably come in 2026 before I'll revisit this at the time. And the other one that I've been harping on for years now, and I just don't, I think some other folks recognize this, but again, you can't underestimate the importance of interest rate. This is another virtually immutable. It is an immutable fact in finance, and it's been quirky lately. Again, there's excessive liquidity can offset higher rates. Risk taking, the market can stay rational longer than you can stay solvent thing. But this is the 30-year bond. The 10-year looks almost identical. I've covered this many times. I know this is being redundant for those of you that follow my videos regularly, but this was a nearly 40 something, almost a 50-year bear market in interest rate, falling rates. Make no mistake about it. There is it's not even debatable whether that's great roaring bull market that most of you know. And yeah, we've had a couple nasty bears within there, but if you talk the 90s, that roaring bull market in the 90s, things got a little ahead. We had healthy bear market leading up to the financial crisis, and where we're at today was fueled by falling interest rates. Again, a secular bear market. Within that secular bear market, we had bull markets where rates would rally. That means bonds go down. And then this is where they hit the nuclear button. We were in a nice downtrending channel of falling interest rates, multi-decade bear market in rates. But then they got carried away. They took it too far. And this is that unintended consequence. They pretty much ended by, like I said, every single metric. The downtrend lines were taken out, the price channel. You have a very clear uptrend of higher highs, higher lows, And to me, it's a matter of I have very little doubt, nothing's set in stone, but I have very little doubt that this ended that secular bear market in rates, and we've embarked on, we're in early stages of new bull market. So best case scenario, maybe we come and back test that. But if we don't, markets have a way of trying to catch the masses off guard. So I've been saying lately, watch for a breakout above this. In fact, I gave you that TLT trade today, and I told you at the end of it's I think a great hedge if you are short or plan to get short anytime soon, because if TLT continues to fall from here, that means rates are going higher, right? That is an immutable relationship. Rising rates on treasury bonds, because credit worthiness really doesn't come into play. Here it is right now. We've actually popped that trend line that I talked about. There's TYX on the daily chart. And if that continues, if that breakout doesn't fail soon, that means yields are going to continue to go up, bonds are going to continue to go down. And mark my words, it's not a flash point, because most people don't see things the way I see them. It's incremental. With every tick up, you're going to get more and more concern in the stock market about those rising rates. And there's TNX, the 10-year, more important really for the markets. And this is what interest rates on mortgages are pegged to, the 10-year treasury. And that one's still at resistance right now, still in the range. So the trade today, if we pull back here, have another move down to the midpoint or maybe the bottom of the range, that means treasury bonds are going to rally. But if it goes the other way, it breaks out. I've given you my color-coded trade by color thing over, 2 years ago now. These zones, green zone, anything here. This is IEF, the 10-year, 7 to 10-year treasury bond ETF. Remember now, prices go down, yields go up. So we're still where the market's okay with where rates are. And that's what I said again. I created this back here in 2024 or 2023. But if we break out, and you can see there's a trend line here as well, right? So if the 10-year and the 30-year bonds start to fall, it means the rates are going to go up, and then they're going to approach this yellow zone where the stock market starts to take note of rising yields in the orange zone. Now, I've had these levels here so long, I might have to redo them. This goes back again since I first created these, but you get the gist of it. And, if you look at, I didn't mean to move that line. That was a divergent high right there. We have divergence there. So, yeah, like I said, that trade I threw out on TLT is, it's a pure play, bounce off support, oversold, positive divergences. TLT and IEF should, quote unquote, with my little air quotes, they should bounce from here. And if they don't, then I'll try to explain to you whether you took that trade or not, what it might mean to the stock market. Okay, there's IEF. Let's see. IEF is also at the 10-year, also at support. Right there. Okay, next up, let me talk about, let's start out with the Fed meeting and what I said the other day. I'll often use, little quotes or lines from movies or books I read. It reminds me, what was that? It reminds me of that was HBO series from the 90s, I think it was, starring Brian Benben. It was called Dream On, and in the beginning there showed you how he grew up watching TV, black and white stuff in the 50s, 60s, whenever he was growing up. And then in real life, he's always just thinking of those clips from the different ones. And I told you the Fed rally. Remember, the Fed reported right here. They had 2 p.m. This was the Fed announcement. Rates went up, and I told you I put literally not zero weighting, less than zero, and I used that pun from the old movie in the late, I think it was late 80s, or yeah. And so if you thought that was bullish because stocks rallied after the Fed cut rates, and as I said repeatedly, from my experience, you can almost bank on the initial reaction from the Fed being faded. So the poor sucker that bought that rally saying, okay, the market likes what the Fed's selling, popped from the 2 p.m. announcement into Powell's press conference about 1%. and so far it's lost over 2.5. So again, that is a great example of not putting too much weighting or any weighting into the initial reaction of a FOMC meeting, letting the dust settle, what I call it. That means waiting for at least a day or two. The dust, typically, they always do the Fed meetings on a Wednesday at 2 p.m., the announcement, and then the press conferences at 2:30. So I've always said it takes at least a couple days. You wait to the end of that week, and then the market's going to pick its direction from there, where it wants to go. And it's given everybody time to fully process what the Fed's doing, not just the quarter point cut, which again, remember, was priced in. They've started now what they're calling the son of QE. They're going to be buying short-term treasury bonds, which is effectively quantitative easing. Should be bullish. Again, the market heard that right away, priced it in, but again, other things are in play as well. So that's the whole less than zero weighting, and you can see so far what how they sold off the Fed rally, post-Fed rally. And guys, hey, I'll be honest, this could be, all this is still within that post-FOMC noise range that I said, that the next couple days after. So by next week, we'll probably get some good ideas if this market can power on through. I think if it takes out that post-Fed high, I think it's safe to say the QQQ will probably break out to new highs. That would be my guess. If it can soak up all this selling that it just had since then, remember, we're not far from taking out the previous highs. So, take that for what it's worth. Maybe if you want to have a tight stop here, if you do have any short positions, or if you're bullish, look, we're at support. This is a level I've had here. 614, you buy this pullback. You consider it just post-Fed, whatever jitters or Oracle or whatever you think's causing the market to go down. Epstein photos being released today. I don't know, whatever you think it is. Buy there and then set your stop here. Because if we take that out, the 614, we're probably going to go to my first target. Remember, my first target's already been hit. It's still support. In fact, it's even better support now. I gave you this level before we even got there. It was based on what I saw over here. The fact that we hit it and bounced only further validates and solidifies that level, because if others didn't see it then when I did, they certainly see it now. It's a very, very significant level. My point being, we've hit it once. We could bounce again for sure if we go down there. But the fact that we've already had the initial reaction, it opens the door, or in other words, increases the odds, whether we have another reaction or not, that we're going to go down through it. But unless we do it, again, that's the October 10th low. So I kind of beat that point pretty good, that from a longer term perspective, I think that's a pretty powerful sell signal if and when that level goes. And until then, we're in a trading range and recognize it for what it is. If you are frustrated from trading the markets recently, that's normal, because the stock market, you can see QQQ and SPY, as I showed you earlier, have gone absolutely nowhere. It's been that's why we jumped down to the 15 and 60-minute charts here to game that little drop. And I can tell you right now, and I'll say it again repeatedly, yes, that is a break of those recent lows will be a pretty powerful sell signal. But this is, and I repeat, this is all day long a very objective short entry, because you're at resistance. You're at the top of a trading range. When you recognize a trading range, the strategy is super duper simple. You sell the top and you buy the bottom. That means short or sell your longs. Once you see it setting up, knowing that it's not going to last forever, and then and if you don't want to game the reversals off the top and bottom and the midpoint, now you can always put a midpoint line there, and that often acts as support and resistance as well. But if that's the case, if you want to sit back and play it safe, wait for a definitive break above or below, right? So that's speaking to the less active trader, someone that doesn't want to jump in and worry about buying, going long or short on a whipsaw. There's your midpoint line right there on SPY, 670, about 674. And again on QQQ, I just showed it to you, it's about 614. And if you haven't heard me say this before, it's not always an exact midpoint. I don't just find a trading range and put a line in the middle. I just always, it's uncanny that a little above, a little below, sometimes right in the middle. You can draw that line. You can see the reactions take place. From when you're below it, it's resistance. But once you take it out, typically you go to the top of the range. Now, we didn't yet on QQQ, but we did on SPY. And SPY is more of the stock market than QQQ. Okay, I'm going to get to the semis. Let me just, I showed you a couple of to me, the most important longer term charts that speak to where we're going, and that's the federal funds rate, what's going on there, the fact that the Fed has resumed a rate cutting cycle that they started a year ago, paused on because they had to back off. They saw long term treasuries going up instead of down, scared the shit out of them. They didn't know what to do, so they put on the brakes, and then resumed the rate cuts recently. And again, that chart I think speaks for itself. But this is one on my theme of kind of pulling things from movies. This is kind of reminds me, if it plays out, of the was that Pulp Fiction. Remember the Bonnie situation where they, the John Travolta and Samuel L. Jackson, they accidentally blow the kid's head off in the back seat, and then they got to bring the car. It's a whole mess. Bring it to the friend's house. Got to clean it up in time before the wife gets home. And that scene was labeled titled the Bonnie situation. Well, this is a Bitcoin situation. Bitcoin, in my opinion, epitomizes, at least if not the current bubble, it's just started. It's one, there's multiple bubbles, but Bitcoin is probably even more so than AI. AI is real in the fact that it's real generating revenues, but as I talked about, it is a complete circle jerk with money going from the Microsoft and Alphabets of the world into NVIDIA then turning around, injecting money into Chat GPT, and then them to other ones. And that's been well documented, okay? Long, probably before even I started talking about it, and certainly after. And it will, at some point, I have little doubt, start going the other way, and it unwinds again. So, it's kind of like the margin bubble popping, where selling begets more selling. Same thing. When Alphabet cuts back and Microsoft decides they're not seeing the return on investment, this massive amount of CapEx spending, they buy fewer NVIDIA chips, NVIDIA goes down, people sell NVIDIA, then it creates a larger scale panic in the semiconductor sector. I'm going to get to that one second. So, but Bitcoin too, and Bitcoin more so that it's nothing. You can buy Alphabet today, you can buy NVIDIA today, and if you have a long enough time horizon, could take 15, 20 years. Possible if things get really ugly. NVIDIA more so is, I shouldn't even say that. Alphabet, Microsoft, Apple, they'll be around and probably back above where they are 10, 15, 20 years from now. Maybe not NVIDIA. NVIDIA is a one-trick pony. It's they build semiconductors, big, GPUs. They could go to the wayside. That's possible. Let's not digress. Let's say that Bitcoin is actually nothing. At least NVIDIA has earnings. They have goodwill, intellectual property rights. They can sell trade secrets, manufacturing, physical locations, investments in other companies, right? Even though kind of all interrelated, those other investments, stakes in other companies. But again, there's measurable, tangible, and intangible assets that they have, right? That's it. Hard stop. Bitcoin's nothing. It's, the late great Charlie Munger said it's the currency of drug dealers and human smugglers and the likes. And of course, Wall Street legitimized it when they came out with these ETFs. But I do believe, I'm not an expert on crypto or Bitcoin, but I believe one day it'll be zero. It'll just going to puff. And I don't know if that time's coming now or later. We certainly made a case here. The divergent high broke the primary trend line, broke the 200s. We went long right here recently, and then we were gonna initially, I was targeting this T3, but I decided for the reasons I told you again to close it out early. And so if this consolidation, because I do suspect at minimum we have another leg down. That's still my preferred scenario. That other leg down could still come after we go up to T3 or all the way up here. Really don't want to see it go much past 61.55, but I do believe whether we bounce a little more or not, we're going to go down, and we could go down quite a bit. This is just a daily chart of IBIT, one of the main go-to cryptos. You got to go to there's a longer term chart of the actual crypto, BTC crypto, trades on the Paxos exchange here. That was a divergent high. There was a trend line wedge break, went down. This is just like that 15-minute chart I started in the beginning of the video with QQQ. Have we been swinging it down, looking for the divergent highs and the divergent lows? Again, on this platform, some of my platforms, some of my lines disappeared. I'm just putting them in there so make sure you see why it was a divergent high. Lower lows on the indicator against lower lows in price. Give you a wedge, give you a sell signal there. Give you a nice downtrend. Again, high double digits, very high double digit downtrend, very profitable to trade short, and just as profitable to get out if you owned crypto, Bitcoin, to get out, go to cash, and then wait to buy it back at once the correction ran its course. Breakout, beautiful downtrend line, bullish falling wedge, breakout, buy signal, uptrend, and that just ended with this divergent high, broke my minor, and then primary uptrend line's been back testing from below, hence why I expect a rejection. Come down to, as I've covered repeatedly recently, 73,500. Most likely get the buyer stepping in there, game a bounce, and then if that goes, then my next target's all the way down here. And again, I don't know if and when crypto ever just kind of poofs and goes to zero, but it really is nothing. It's represented by nothing but bits and bytes. That's all it is. And I guess where I can't wrap my head around what makes Bitcoin so special, I know it was the first, to market, if you will, but what prevents anybody, and we've seen the proliferation of additional coins. Some are finite like Bitcoin, some aren't. Obviously the ones that aren't finite should have no value, but even those that are, what's to say somebody doesn't come out with Bitcoin 2.0, Bitcoin 3.0? Right? So in other words, kind of like share price dilution, but yet on something without any earnings or value. So that's kind of my longer term. I don't trade on long-term outlooks. I trade on technicals. And so there's my current outlook, which has, just so you know, from where we just back tested, that's another 21% drop to that, my next target there. And on that, guys, it has to do with, let me go back to this right here. This. Again, I don't have the actual statistics. I wish I could access that. But I can guarantee you a lot of these folks that have ramped up here on margin, I can guarantee you a lot of that, a significant portion is in crypto. Be it, I know there's, there's futures contracts on Bitcoin. There's all the ETFs have come out. Even before those ETFs that came out, you had GBTC and the likes, but now all those ETFs that have been rolled out. And then again, and don't forget about the crypto proxies. Those are stocks that are, most of those are marginable. A lot of those we traded recently. Riot took it at the lows with Bitcoin. Coinbase, Mara, Hive. These are what I call the Bitcoin proxies. They are in one way or another, related to crypto. And this is another big one here, MicroStrategy. And so if and as Bitcoin falls, MicroStrategy, who has, or it's now called just Strategy, they dropped the micro part of the name, but they kept the symbol. That is going to be a vicious cycle as well. And so, and I've looked it up. Okay, I know this company, their business model based on accumulating and holding Bitcoin, right? So they're going to obviously track the price of Bitcoin. So it's, no mere coincidence. This chart mirrors my Bitcoin chart, right? Pretty, to a larger, lesser degree. There's your uptrend line. These are the downside targets. I still maintain this target, which correlates with my next target on Bitcoin, right? Little consolidation here. This is one intentionally, I didn't give this one to you as a long, even though you could, we went long the day of the lows. We could have, you could have made a bounce off it. But I think this will go down. And then this, guys, where I'm going, and this is why I do these long-winded videos, I have a theory. It's just a theory that and I looked it up the other day. I don't have the numbers in front of me, but it's significant. I think it was about 3 trillion in nominal notational value right now of Bitcoin, including the ETFs and the crypto. And I don't think that included futures, and I know it doesn't include these peripheral companies like Riot, Coinbase, Mara. Um, and so that's on right there is about the value of NVIDIA right there. Poof, that's a lot of money. And again, that's just a small portion. If you take all the related things that are related and tied into Bitcoin and will fall with it, the number's pretty big. So my theory here, it's a working theory, is that I want to say not if, but when the Bitcoin bubble truly pops, it's going to have such a deflationary effect in such a vicious cycle because as Bitcoin drops, all these related companies will drop with it. That's going to take the wealth effect out. It's going to cause margin calls to make people sell NVIDIA. Let's just say the AI bubble itself hasn't popped, but they start selling Alphabet, they start selling Microsoft. That's going to put pressure on them, which ultimately puts pressure on NVIDIA. And so I'm watching this closely. And again, it's a theory that if Bitcoin really gets underway on a real bear market, and this company doesn't just buy Bitcoin, hold it there. They do it on leverage. And I've looked this up. If things get bad enough, they are then forced to sell their Bitcoin to meet debt obligations because it's a leverage play on Bitcoin, which, as you guys know, then that creates that same vicious cycle I was talking about with the margin debt bubble. Now, I know I'm getting, 3, 4, 5 steps ahead, but it's all interrelated. So all you have to do, you don't have to believe me, but just watch this. And this looks like still a little bear flagging action. So if we go down, break down from that bear flag, we'll come down here pretty quick. And then remember, selling begets more selling. And if we reach a point where it gets, we continue to fall, if you do get that vicious cycle for whatever reason, and Bitcoin keeps going down, then MicroStrategy starts to unload and potentially blow up, where lower prices again lead to more selling. They have to sell their more and more Bitcoin, which again, you understand that how a vicious cycle works. So, all right. I don't mean to be all doom and gloom, guys. And, I made a case, this was a sport. We bought it. We bought Bitcoin, all that. I told you I was happy booking the quick profits. If we go up here, great. And everything that I'm talking about today, I might be revisiting now 6 months or a year from now. Maybe we bounce. Maybe we come and we back test this trend line. And you're going to say, oh, Randy, you're all doom and gloom. I'm showing you what the ifs and what needs to happen to trigger that scenario. And that is support level. Of course, this recent trading range, we need to go down here. That's going to be certainly a start. That's really big support. It's also big support on Bitcoin, as I showed you. Correlates with it. If we take that out, then that party's getting started, guys. And for those of you that might just be baffled or think that I'm, smoking something with these 50, 60% downside targets on the NASDAQ 100, it all plays into it right here. All right, guys, another phone call there. I realized I muted my ringer for an hour, and it's just that hour's up. So I just looked at the clock here. I'm rambling on. Let me get this out. All right, so you guys have levels. You have my thoughts. Let me see if I get it. No, I'll get to the semis. Oh, and on that too, again, on my whole theory, again, everything kind of ties in together, is this one. I expect a spectacular short when the time comes on Robinhood. Robinhood, as you guys know, epitomizes, in my opinion, the whole crux of the risk taking in this market and who's doing it. Going back to I think the meme stocks, AMC, GameStop, crypto. This is your crowd right here. It's the younger generation. I know some of you listen to my voice are fit in that category. This is no offense. I'm just making an observation. These are known facts. Typically you get the younger generation comfortable trading on their cell phone versus, sitting in front of a computer, analyzing a lot of charts like I do, frequenting social media, different blogs and trading rooms and chat rooms to get their information, versus the old fashioned way. Either way, again, that's I don't think debatable who the market that Robinhood has, and the growth has been spectacular, and it's reflective of this. So remember, this all began after COVID. The government shoved money up down people's throats. people that didn't even need it, businesses that absolutely did not need it. I can vouch for that. The PPP, Payroll Protection Program, stimulus checks. Not everybody got them. You know, if your income was too high, you didn't get one. Otherwise, everyone else got one. And that coupled with people sitting at home and the rent forbearance and everything else, you didn't have to pay your rent, you didn't have to pay your student loan, you were getting paid to sit at home, and it started this whole new generation of and also excessive risk taking. Again, the meme stocks, a lot of high growth tech companies, AI stuff. Look at the return since they peaked. And remember, this is where the stock market, when we go back real quick. So QQQ, right here, late 2022. Here's my year breaks. End of 2022 in the fall, peaked. We had that divergent low right there, and that set up this bull run right here. And from that time, Robinhood grew. They peaked a little before that. Look at this return. See the pop-up box on the left and green on the bottom? Almost 2,200% return. This is a stock. This is not a meme stock. I mean, they profited from that. Again, a lot of trading volume, and so what happens in a bull trend with the market going up, with margin still cheap and plentiful, as long as the market goes up, this company should do well. Once it starts going down, I can assure you that 90+% of these traders have never seen a bear market, wouldn't know, and won't recognize it until they're probably pretty much wiped out. That's my prediction. I do have a background as a financial advisor. I kind of know the type in here. I've got 2 young children that are, college age and have these accounts and can see what they like to trade and what they do. So that's it. I just want to just put it in perspective. So 21 again. I use log scaling. Let's not forget that either. If you put it on arithmetic scaling, this stock has gone parabolic. I mean, it's gone parabolic either way, but log scaling is better to use when you have something with a big price change. And if you want to just compare it, you look at another broker. Let's just pick one, Raymond James. So what are they up since they troughed here in 2023? They've grown 115%. Impressive, but not Interactive Brokers. Probably catching a part of that younger generation since that same time period. They're up 421%. Again, that is dwarfed by what Robinhood has done, right? And so I just want to point that out. It's reflective of the type of traders and the type of securities. These people aren't buying Coca-Cola and Procter and Gamble. Again, I'm generically speaking. I'm not being literal, but they're not buying treasury bonds and utility stocks. They're buying the high flyers. And once those accounts start imploding, when that margin debt bubble unwinds, this stock's going to have a lot to fall. It's got you can see this trend line down here is going to be depending if and when we hit it. There. Let's just say this right now is a preferred target. That's $67. That's going to be a 48%, called about a 50% drop from where we're at now. From the highs, would be a little bit more, 60%. And depending if and when we get there, if my analysis is correct, we probably peaked. We put in a divergent high. We broke down, back tested that trend line there. So the way this looks, you zigzag, they buy it on the 200s. You work your way down there, and this trend line should come in roughly with that. Or if we get there first and bounce, and then go down and hit the trend line. But I think we'll come back to this long-term trend line. So I'm sharing this as both a trade idea, but more so, it's, right now I can't make a screaming case. Yeah, they did break down back test. It's probably going lower. Obviously, it'll help to take out that reaction low. It'll also help. You can see all my support levels. It needs to take each of these out, then the 200. So once it takes out all these 3 levels, it's also going to have taken out the 200-day moving average at these 3 price points, and then it's going to come down here. And I don't see anything stopping it. Once it takes out $95, I would have, if I'm short that stock, I'm going to have zero desire to cover it unless I see something in the sector in the markets. Otherwise, it's going to be a relatively straight shot down with very few reactions all the way to 67.27. That's a 29% drop. All right. as promised, another long video. I didn't promise that, but as promised, SOX, Semiconductor Sector ETF. The crux of the bubble here. They're big sled, big dog there, Nvidia. I've covered this many times. Recently coming off a divergent high. You've got this little trend line here that may do the trick. It's not a super duper well-defined trend line, but that should do the trick. On the weekly chart, I have multiple here. This is the board I'm focusing on. That was a divergent high. We hit my first of 4 targets. We bounced off that first target, which is typical upon the initial drop to each target. And so this is just a whole, a trade playing out. And next stop should be T2, T3, then T4. It was 72% when I first called, when we broke the trend line here and I gave you these long-term targets. If it's hit now, T4, it's going to be a drop of 81% because we went up a little higher, made a marginal new and still divergent high. There's your divergence lines. There's the last divergent high on the weekly chart. Remember, this one right here, this is a continuation. It's the same divergence. It hasn't reset. This was a reset. That was a divergent high. You had a little one there, kept going, and then the correction came and it was 69%. We hit my second target right there. All right, so that's what NVIDIA looks like longer term. Let me get to the rest of the semis. Go back to the sector itself, SOXX. As mentioned, we put in a divergent high and a bearish engulfing candle on the weekly, and we still have that divergent high. This is a daily chart here. Marginal new and still divergent high. Remember, I had this before we even got there. I had divergent high with a question mark, meaning I could see it make a marginal new and still divergent high, just like the stock market. And my prediction was if that happened, it would fail. So far, the breakout has failed. And this was your previous high. Took out and made a marginal new and still divergent high yesterday. And look how hard they're selling it right now. There's that extension, the yellow line extended that. So no change in the technical outlook. And if this sector buckles, it will take ultimately the NASDAQ 100 down with it. It's the semis, I always say, are the canary in the coal mine for the tech sector. Tech is by far the largest sectors of both the NASDAQ 100 and the S&P 500. And ultimately, it'll spill over, but you have to see it spill over into the financials. And when the financials break, I've covered that repeatedly, they're still above their 200-day moving averages and key price support I gave you on XLF. But let's just rifle through the individual components of the SOX Semiconductor Sector ETF. This is Broadcom, reported last night. They initially popped in pre-market on an earnings beat, but as I've told you repeatedly, from my experience, most of these companies will peak on blowout earnings, record earnings, and it just reaches a point where the buyers have dried up so far. And then it went on to break this trend line here, so that's what's dragging, in large part. All the semis are red today. You can see my watch. This is the components right here of SOXX, the Philex Semiconductor Sector ETF. We've got one green one right now, and that's barely up, STM. So that's it. So just like that was a divergent high, and there was a breakdown of the trend line, we made a back test, another back test, now rejection. We're testing the 50-day moving average. This yellow line I gave you before is still a very, very important yellow line, support level to me, and by no mere coincidence, it's that key October 10th low. So like I said, not just the markets, most of these key tech stocks, be it semis or Alphabet or Microsoft, those that haven't need to break those October 10th lows. And then in my opinion, it's going to be lights out for the market. So that's what that one looks like. Taiwan Semi just broke down the minor uptrend line after putting in, yep, you got it, marginal new and still divergent high. That breakout to new highs has failed. And now it also gave you a sell signal based on that minor trend line break. Next support right here, 279. You can see all my levels. ASML, divergent high, trend line break, moving lower. AMD, divergent high, bearish rising wedge breakdown. Came down here. It's been testing this trend line on it right now. So if we can go a little close or take out today's lows, or especially close below today's lows, will have taken us below this nice, well-defined uptrend line. And you can see right here that 202.42 is what I call a BOD, or benefit of the doubt support level, because it lies slightly below the uptrend line support. So you really want to see that go. When that goes, that's also a massive gap. This is a big gap right here. Gaps once entered are typically backfilled. So you're looking at a big drop there. And if AMD goes down, that's going to definitely put pressure on the semis, which will put pressure on the NASDAQ 100, which will ultimately put pressure on the stock market. MU, Micron, same story, guys. Birds of a feather flock together. So I know this is a little redundant now, but I need to show you, because I don't. If I wanted to make my case, if I was bullish on the semis or bearish, and I just picked one semi, let's just say Nvidia, then I wouldn't be. I could easily present my case, but as I often say, a index or a sector is simply a sum of its parts. So if you really want to know where it's going, you need to look at those parts. And if 60, 70, 80, 90% of those parts are all singing the same song, meaning they're all breaking down below support or breaking out above resistance or a bullish chart pattern, that's likely where that entire sector or market is going, or index. So there's a breakdown. So until yesterday, we had a marginal new divergent high, one that I predicted would fail because it was still divergent high overbought. But now we have a sell signal. So let's see if these stick. If they stick, where to? Well, right there. What's that? You got it. October 10th low. Big support, 193.92, plus you get an added bonus. If it takes that level out, you're also going to take out this uptrend line. And that's going to be big time bearish stuff. Take you down here to 157.45. You'll test the 200-day exponential, then the 200 simple. That to get down there is going to be a drop of about 40%. Imagine what that's going to do to the semis. So if you are long and strong the semis, you might just consider, watch these levels, especially that one, for stop losses. And if you're bearish, well, these are targets where you can gain bounces if the charts dictate or confirm at the time. And you can also add to or re-enter short positions if those support levels are broken. AMAT, divergent high, failed breakout to new highs. Lam Research, marginal new, still divergent high, followed by a sell signal today, a break of the minor trend line. Uptrend line. Qualcomm needs to break that trend line. Intel coming off a divergent high, also massive long-term support. This is my weekly chart on Intel. Peaked back here with two equal divergent highs. Same thing. It started building divergence from this point here. Divergent high 2, 3, 4. Number 4 did the trick. Took several years to build, because why? This is a weekly chart. I'm not going to show you divergence on a 60-minute chart. You need to go out to the weekly. The weekly tells you where things are going long term. And then when Intel broke its secular bull market uptrend line, it was lights out. And guess what? If you missed it, you were given a gift, a back test of that trend line. And if you took that gift, you made 63%. That's the drop from there. Now, where we've come is full circle. That was a divergent low. If you followed me for a while, and these are in the archives, Intel was one of my favorites. We went long several times at this long-term support level, and even exited and got back in, and then it finally broke out. That was a nice spacing pattern with a big fat divergent low. Just like these divergent highs are nice to short, you want to go long on divergent lows. So I wish I'd stayed long the whole time. I don't like when government starts intervening in companies, and so let it just run its course. But look, that's good. That's the bottom of the base. This is where it started basing right here, or topping. That was the bottom. That was support. And once that support let loose, there was the trend line break and back test, but once that was very, very good support, and then the bottom fell out once that support was taken out. We're back to that now, and we're also at this downtrend line. What I'm doing here is just showing you these are the big semis right now, the ones that matter. And so while I don't have any sell signals per se, it's at resistance. There's two ways to objectively enter a short position: on a break of support, which may include a bearish chart pattern, or on a rally into resistance, which this just was, and still is when you're looking at a weekly chart, if you're trading long term. All right, we're almost done. Texas Instruments, back testing the 200s. It lost the 200s right here. 200 simple and exponential. It's been back testing those. Recently broke this minor uptrend line. And so if it gets rejected, it's going to go lower. KLAC, minor trend line break right here today. So a lot of them just broke trend today. They're minor trend lines. There's still some bigger support levels, still some work to be done, but it's a start. We'll see if it carries through next week. Again, this is, I'm repeating a lot. It's December, guys, so whipsaws are more frequent in between Thanksgiving and Christmas from my experience. ARM, this one peaked here, divergent high, then it took out the trend line and just got rejected off the 200 exponential moving average, but really needs to break this support zone to drop more. ADI, analog devices, just borrow you, and that's all that is, just an extension of the big divergence that's been building. Divergence is not a sell signal. I don't have one on this one right now. Marvel, divergent high 1, 2, 3, usually the third time's a charm. Breakdown of the trend line, been moving lower since. Needs to take out this trend line and that 200-day moving average for a much bigger drop. And XPI, I don't have an opinion on that one, much of one, at least a little minor. We have a reaction right here. That's, yeah, and one there. It is resistance, but not my favorite. MPWR, divergent high, sell signal on the breakdown. Bounced off this support level here. That's it, little kickback rally. MCHP at resistance right now. That is this, you had a trading range here. Like I said, you buy the bottom, sell the top, buy the bottom, sell the top, buy the bottom, sell the top. Then whichever way it breaks, that's your next tradable trend. And we hit that support level there, bounced. Where we come? Right back to the top of that level, which was resistance then. If you missed it, pretty clear. Overbought. This stock's probably going to go down from here. TER, Teradyne, divergent high, trendline break, sell signal, next stop. CRDO, divergent, no, that's where the divergence started. That was divergent high 1, which also correlated with a back test of this trendline breakdown here. Rejected there, bounced off. You got it. October 10th lows, key level. There, keep buying it there. Made a second divergent high, moving lower. Once that level goes, should be next stop. All these other targets that I have down there, support levels. ALAB. We're getting down where these guys don't move the needle that much. Remember, I have my components sorted by market cap, so you can trade them, make just as much money on a $100 million company as you can on a $3 trillion company if you get the move right. But that's it. That one's walking up that little uptrend line, back testing the 200s. ON on semiconductor, testing key downtrend line resistance, bullish if it can break it out, and the sector moves up. Because remember, if it breaks out of here, this is why I do this type of analysis. Let's say I was bullish on this. So look, this is one of the better looking ones coming off a divergent low. He likes that, you know that. And nice, clean, very well-defined downtrend line. So here's and a bull flag. So there's a lot to like about this one. So here's my take. If the breakdowns that I just spent 15 minutes on showing you all these semis breaking down recently, put in divergent highs, if they prove to be whipsaws and they come in and buy this up because just money inflows to the stock market overwhelm the technicals and we rally into year end, this would be one of my favorite top picks right here. Bull flag, you take that's your flagpole. The flag, you take the flagpole, add it to the lowest part of the flag before it breaks out. It's going to bring you right up here to my next target, about $67. That's going to be a 17% rally or profit. However, if this breaks out, what you want to see, you wait for when you see a bull flag or bullish pennant pattern, you wait for the breakout. If it breaks out and starts to get going, you're, oh yeah, nice, bull flag breakout. And the rest of those semis go down, I highly doubt this is going to play out. It'll probably be a failed breakout. Again, birds of a feather flock together. Again, but like I said, one of the better looking ones. So for those of you bullish, I would buy this thing 10 times over before I'd buy Intel right now, or even Nvidia or anything else like that. I wouldn't buy it yet. It has to break out. And the sector has to hold up. You want to see the sector hold up, is my opinion. UMC, divergent high, needs to break this trend line for a sell signal. ENTG at resistance right now, overbought. ASX, divergent high, a little uptrend line starting to crack that. There's your negative divergence. There's your trend line that it's probably going to go to. It'll have a little hiccup right here first, 1342. Price support, gap, reaction low, and the trend line. That gives this one a total, if this plays out, a drop of about 16%. MTSI, divergent high, just broke down. First target down there, 154.50 in the uptrend line. RMBS, breakdown right here. After divergent high, trend line breakdown, back test. As I often say, the problem with shorting a back test is you can continue to back test. So what I really like to see is an impulsive rejection. That's exactly what that is. And it coincided with a break of a little minor trend line, which gave you a little wedge pattern on the back test. Boom, boom. Now we're at support. So had you shorted this one on the back test, this is where you'd almost be at the first profit taking point, about a 10% drop. It's got a little more downside, 95.50. Then once that goes 76, that's going to be about a total of about a 28% drop from the back test. All right, guys, I'm going to wrap it up here. This is the last one. That's all components of the SOX. Super long video. I'll probably put it in the notes. Remember, you can speed these things up. Very easy to do. Go to the bottom right-hand corner. Any YouTube video, including these. Increase the speed to 1.5, 1.75, whatever you want. Also, I'm trying to include a link now. A couple subscribers that asked for that so they can play it from their computer without having to go to the site. Just keep in mind, if you're getting hit up with ads on YouTube, I do that if you play it from the site, I don't think you're going to get any of those ads. So if you come in the right side of the chart, you can watch these videos without getting hammered by ads. YouTube's getting super aggressive on that. They're trying to force everybody into their premium YouTube premium plan without ads by just increasing the amounts. It's getting ridiculous, but whatever. It's their business model. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.